Well, I think that makes at least two of us. All right, we'll get started in a few minutes. I'm still letting people in currently. Hello, everyone. Give me a second. I'm getting set up on this end and still admitting people into the event. Okay. Well, we have a few folks here. It's 3 minutes after. Um, I think I will go ahead and start. Um, so the purpose of this meeting for me was to sort of just have a time when we could come together and talk through whatever sort of challenges people were having on deals, whatever questions that were out there, whatever things that were on top of mind for people, and just have an open forum to have discussions. And so I asked for a couple of questions before we started, and some of those I've been going back and forth. Noel, thanks for being a sport on that. Um, I believe there was another, at least Troy came with some questions, as did a few other people. So I will try to get through those questions and then also save time for any questions you guys have. Um, I will try to speak sort of at the level of a person who's just starting. So for people who have been at this a bit longer, forgive me. I want to make sure it's inclusive. And if anybody has any specific questions that they maybe thought of right now and didn't think of earlier, then just let me know in the chat box, and that'll give me a chance to sort of think about what's an answer and how to sort of provide some data that would be helpful. So um, it may be easiest to start with some of the qualitative questions that came over email. And so let me pull up what you guys sent. Bear with me a second. Okay. And maybe what I'll do is share my screen here. Give me a second as my share screen pops up. There we go. Okay. Are you guys able to see my screen? Are you guys able to see my screen? Okay. I couldn't see you while I was on the screen. All right, cool. Thank you. All right. So Grant was nice enough to send over a couple of questions, and I will answer these from the point of view of if I was in the buyer's seat. So, first question was, before signing a letter of intent, the seller is asking that I sign an agreement stating that I would not be looking at any other businesses during exclusivity. Is this normal? No, this is very much outside of the realm of normal activity. Brokers will try to get over as many different ways as they can. Sort of always have to be mindful of that. But exclusivity is the seller cannot solicit um, new buyers during his process, it does not put limitations on the buyer. The buyer is spending an inordinate amount of time looking at, evaluating, paying money to get more comfortable with the deal. And so that's not something that typically comes as part of a exclusivity agreement at all. So that was the first. The other here is about working capital. The business I'm looking at shows $0 for AR, AP inventory, likely the result of cash accounting we can't verify. Should I then be expecting the seller to leave behind a certain amount of cash from the deal for my working capital? How could one calculate the figure without AR, AP, or inventory? So let me just answer that. And before I answer that question, how many of you guys have come across any sort of working capital challenges in deals you've looked at thus far? Okay, Randy. Um, I'm assuming it has something to do with the seller wanting to keep their AR or having tough negotiations over the peg. Okay. Um, so in almost every deal that includes a business, call it under $1 million in EBITDA, there's typically a significant back and forth around working capital. If you were buying a Wall Street business and a bunch of investment bankers were in it, then everybody would know that you buy a business with the working capital that's on the balance sheet. When you're buying smaller companies without the same intermediaries, the sellers think of accounts receivable as revenue they earned that hasn't been paid yet, and you can show them as many books as you want. It will be tough. I highly encourage people as a result to put a working capital number into their letter of intent, even if it's directional, because more than likely that's going to become a point of negotiation and you want to get out in front of it. To Grant's question about there's no AR or AP, how do I sort of handle it? Here's how you handle it. So people will say they're on cash accounting, but when they present to the IRS, they have to present balance sheet stuff. And so you end up seeing non-cash occurrences, even in companies that say they're cash accounting. You'll also hear a lot of companies say they're accrual accounting, and at best it's accrual-ish. So be careful trusting whether somebody says it's cash or accrual. It's very tough to know. The way that you can get to accounts receivable and accounts payable, if you have to, is accounts receivable is the aggregation, so the sum of all of the outstanding invoices due to the company. And if you think of accounts receivable aging, it's just how long have those invoices been out? How long has that money been owed, right? So what you can do, Grant, is if there's no AR, you can just ask for all of the outstanding invoices. And I promise you, any company that collects revenue, which I think you guys are all buying companies that collects revenue, they'll have some accounting somewhere for all of their invoices, and then you aggregate and put them in a spreadsheet and say, look, maybe you get them for today, maybe you get them for 6 months ago as well, maybe you get them for the end of the year. You may want to pick 2 time frames to have a comparison. And then you might say, look, at January 15th, 2021, you had $355,000 of AR. And so that's what I'm expecting will be in the business when I close, plus or minus. So the AP can be a bit more tricky. It's typically, for small businesses, it's probably some portion of their payroll. So you can look at the payroll and say if they get paid every 2 weeks, then on average, you're going to have 1 week of payroll, so 1/2 of a 2-week payroll. So split the payroll in half, and that's part of accounts payable. Also, if they have contractors or significant contracts for service providers or softwares or all of that, those things can be in accounts payable. So depending on how much digging you want to do on accounts payable, you can figure that out as well. The other thing that you can look at is a broker will tell you something, the seller will tell you something. Sometimes it's good to go talk to the source. So who's the controller, who's putting the numbers into QuickBooks or whatever their financial system is. And even if they say they don't have it, schedule a call with that person and ask the question again, sometimes you'll get a different answer. This is generally about valuation. So a $600,000 SDE deal, they're asking for 4 times multiple. Let me ask, you guys are all looking at deals. If you can put it in the chat, Grant, if you don't mind us having a little bit of fun, do you? What what are you guys paying as a multiple of either SDE or EBITDA in general on the deals you're looking at? Can you just put it in the chat? How about we do it this way? Raising hands. Is anybody paying over 4 times SDE, or have you put in a letter of intent on something that high? 4 times seller's discretionary earnings. And keep. Has anybody put in an offer under 3 times? How many of you are making valuation determinations off of seller's discretionary earnings? Raise your hand. How many people are more focused on EBITDA? Raise your hand. Okay. Grant, and I think I said it in the email. I just want to revisit it here because sometimes the live conversation can be helpful. And if you have additional questions, please pop in. Brokers love SDE because it's bigger. I hate SDE because it's bigger. Sometimes I have to swallow SDE, right? I can't avoid it. What I do in that case is I try to push very hard on the fact that a seller's discretionary earnings multiple is not the standard valuation multiple for businesses, and use whatever evidence you can. You're not going to convince a broker with evidence. I just always like coming with it when you're trying to negotiate something so fundamental to the deal. And then I think I say, look, if it was EBITDA, I could pay 4 times. If it's SDE, I can only pay 3. And I think you start the negotiation around there. And I think you additionally push on the fact, so if I buy the company based on all of the earnings the seller received, and the seller was an owner operator, who's going to run the company? And you start asking these questions that don't get you necessarily to a new number, but they start throwing punches at the broker's thought process around charging such a high multiple around SDE, right? It's just hot. Now, some businesses are worth it, Grant, and I don't know enough about the one you're looking at to know. I do think that around 3 times SDE is probably the richest I would see for a business under $1 million of SDE. But that's sort of an answer to that question. And then not seen, probably more entertained. And I missed, who's that coming from? Is that you, Randy, or no? You, Grant? Okay, sorry. Grant, I've seen almost everything, to be completely honest. I mean, 10 times SD. If the broker can get it, he's going to go for it. I would say the middle 80% of the stuff that I've seen around SDE is between 3 and 4.5 times SDE. Where I've seen deals consummated, though, is between 3 and 4 times SDE, and typically structured so that a significant portion of that was not delivered at close. I know it's a frothy market for sellers, but I still believe that businesses under $2 million in EBITDA, unless there's hyper growth, should trade at 4 times EBITDA, plus or minus. Going back to the market for smaller firms out of Harvard Business School, that I'm sure you guys are familiar with, or some equivalent article. That's what I'm used to paying So that's my experience. Sure, it's the market for smaller firms. It's part of the ETA, How to Buy a Small Business. Kind of, they call them books at Harvard Business School. They're really cases strung together. Uh, and I'm laughing at myself. So I hope that's everyone's aware. I love them, but they're cases. But I say the market for smaller firms is the best single article for what you guys are doing. I would highly recommend reading it, and if you haven't picked it up in 6 months, rereading it. I think it goes into a lot of detail. Grant, I'll also caveat it. Every person who's worked with me, I've given them that article to read, and I always bring them back to the first page. The authors of the book are search fund investors, so you have to understand their bias for inflating cost of diligence to make people go to them to do a search. For those who are self-funded, don't believe a single number around the cost of diligence um, in that article. Um, oh, customer concentration. Hey, Grant, give me some more on this because I want to make sure I'm answering this correctly. What's the issue with customer concentration? Okay, cool. Thank you. Um, sure. Right. Right. Great question. There's two or three levels to this, Noel, depending on how much leverage you have and how open they are. In an ideal world, let's say they had three customers that made up 80% of their business. I'd ask for a balance sheet from all three customers or some indication of financial solid pro forma. Um, that's going to be tough to get, right? But if I had a magic wand, I'd go for it. If you can't get that, I would try to not just get the name of the customer, but I would say I need a deep dive, almost like 3-page report on who that customer is, where are they located, how long is the relationship, who are their customers, da 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 da. Right. The other thing is diligence is interesting in that some diligence you tell people you're doing, like in an interview. Like Elliott, give me your references. I give you the people who love me the most. Here's the 3 references that I love. If you're smart, you go on my LinkedIn and find people that we're mutually connected with and call them and see if they like me too. So you might get the number to the customer and inquire in some other way about the financial soundness of the business. I mean, I can think of a lot of different elegant ways to do it. Think about who in a business would know first if it was going bad and try to get in contact with them. If you can find a blue collar person, probably better than white collar. They tend to be more honest and open. Um, the other thing you can do, depending on how much money you're spending and how proactive you are, and Noel, I've done this, so if you do this, don't feel weird. I've driven by customers to see are their trucks coming in and out. Is the parking lot full? Can I get somebody from? If I can get somebody same day at my house, or product in 4 days, one thing. If it's say I can't get it to you for a week, or I can't come out for 2 weeks, something different. So those are ways to get to the financial soundness. And here's the final way. That's Are you guys hearing an echo on your end? I hope it's not bad. Okay. Um, most things can be handled by either adjusting purchase price, adjusting structure. If you can't get it there, you adjust the purchase agreement, and this is where financial and accounting diligence connects to legal. you can say it's a tough market. I'm willing to believe that 2020 was an off year and you'll be able to rebound in 2021. But 40% of your business comes from customers in industries that I'm cautious about. We need to share the risk on that in some way. Whether I pay you out that AR as it comes in, or we do an earn out if those customers last a year, I need some risk sharing, whether that comes in the form of escrow that's exhausted or an earn out. That's another way to protect yourself if you're not able to get the data you need. Very welcome. Okay, let's see other questions. You know what, Noel, do you mind if we hop into your question we kind of went through earlier? Noel and I had a good couple conversations this morning in between other things we were doing. Um, I'm thinking of how to present this. So, how many of you guys have done a cash flow model for a deal that you've worked on, kind of ever, or are comfortable with cash flow modeling? Anybody? Okay. All right. Cool. It's a nice to have, not a must have. As an engineer undergrad, I used to hate it when I was doing consulting and people made this stuff more complicated than it is. So I'll try to make this very simple. Noel sent me a model. Let me scroll up a bit and then make this a bit bigger. Okay. Are you guys able to see the model? I'm probably getting thumbs up. I can't see. Um, okay. So Noelle sent me a model where she was projecting her cash flow over the next, whatever, 6 or 7 years based on the current scenario of the business. So what ended up happening was that she kind of got stuck in the middle of the add back conundrum. EBITDA is before interest, tax, depreciation, amortization. Cash flow is after, and so you have to sort of think about that. So she had sales, COGS, gross profit, total operating expenses, and I'm going to come back to this in a second because it's important, and you guys will run into this. Oh. And then was going to get to cash flow. Let me go back to the projection. Was going to get back to cash flow by this initially when we talked, Noel, was net operating profit. And so she was going to take net operating profit, deal with the interest expense, deal with amortization, depreciation. And so to get to cash flow, you have to pay out the interest expense. So she was going to subtract it. She was also going to either subtract or add, I forget which one, the depreciation expense. We'll come back to that. And then taxes to get down to net income. And then she had some math down here that got us back to adjusted EBITDA. And when we talked this morning, one of the things that I want to help you guys with, without getting too deep into financial models, is so total operating expenses for these businesses can mean a lot of different things. So you really need to be clear when you start adding stuff back and subtracting stuff from what's already in something like total operating expense. So for instance, we were acting as if depreciation was not included in total operating expense. And when we went to the income statement, we saw that depreciation had already been taken out as a part of total operating expenses. And so when I talked to Noel, what we realized is that this line, this net operating profit, is really EBIT. And let me come back so I can see your guys' faces. Who knows what EBIT is? Anybody? All right, good. I wasn't expecting that many hands. As nerd as it sounds, I would encourage you guys in models to always use, EBIT, EBITDA, wherever you can, because otherwise net operating income can be confused with net income, particularly if you're at 10 o'clock and modeling after work and all the rest. And so with EBIT, it's before interest and tax, but depreciation has been taken out. And so once we realized that, everything that flowed down to EBITDA and net income made more sense. But there was an issue about whether to add or subtract depreciation that was cleared up once we realized that the net operating income was really EBIT. And so I'd encourage you guys to do that. It just saves time. And then if somebody else is auditing your model or looking at it, you don't have to clarify. They know what EBIT is. And then you can look up EBIT. It has a very specific definition. I'll also say this. The bank, okay, who knows why EBITDA is used so often in business acquisitions? Anybody? No? So this word that we all use, we don't quite know why we use it. No big deal. So I didn't know for a long time either. So you can't spend revenue. You actually can't spend profit, right? Profit is not in a bank account at the bank. You can only spend cash. But the third financial statement, I'm not going to put up a middle finger. The third financial statement is cash flow. And that's a more complicated statement. And most times what people send is the income statement and the balance sheet, no cash flow. So you can create the cash flow statement from the income statement and the balance sheet, but very few people do. Not a big deal. So when the bank gives you covenants, they give you covenants that are based on EBITDA, because EBITDA is the closest proxy, it's the closest thing to cash flow that only requires an analysis of the income statement. And that's why EBITDA is used. It's used sometimes synonymously, which isn't accurate, but it's used kind of head to head with cash flow. And I'm managing how nerdy I go. So I'll stop there for that piece. That's why we use EBITDA. It's a proxy to cash flow. So when the bank's looking for covenants, they look at covenants compared to EBITDA. EBITDA coverage ratio, debt to EBITDA, all this kind of stuff, right? You as a buyer should know that EBITDA is not cash. You can't go to Chase Bank and say, hey, I want to take all my EBITDA out. You can only go take all your cash. And so as you're thinking about EBITDA minus interest, minus taxes, right? Any principal payments you're making on debt to understand your cash flow, you should know that's not all the things that impact cash flow that you should be aware of to a certain degree. And Randy, I see you looking at me. Are you still with me? All right. So I like using practical examples because it just makes more sense. So I make widgets at Elliott's Amazing Widget Company. And I want to assess Elliott's cash flow over a period of a month, let's just say, for instance, right? So I look at my model and I do everything on the income statement, take EBITDA, subtract all that stuff out, have a principal payment on debt. Okay, boom. I've got $50,000 of EBITDA less interest, tax, principal payments on debt. I'm ready. No, I'm not. Elliott has to buy new inventory, right? I make widgets out of metal. That's not free. Whoever I sold my widgets to took some inventory out and finished goods. Now I need to replenish that inventory. I need to go buy inventory. That's a cash outlay, right? Let's say a customer bought more in. Oh yeah, customers actually don't pay the day that they buy or receive goods in most businesses, right? So I sold Raven $1 million of widgets, right? He doesn't pay me $1 million today. He really gives me an IOU. It's weird, right? So I send Raven the widgets. He says, Elliot, I promise to pay you on terms of 45 days. So in the income statement, you're going to have revenue minus costs, EBITDA, all the rest. You didn't receive that cash. You received an IOU for that cash. And so accounts receivable, which is essentially that IOU, is a use of cash. I sent him real product, real cash equivalent. I could have sold the widgets to somebody else who might have paid day one. Raven's paying in 45 days. That cash doesn't come to me for 45 days. So that is a use of cash until it comes back, and then it's a source of cash. I won't go through each and every change, and I don't want you to feel so scared that you're not comfortable. What I'm encouraging you to do is it's almost an iterative process. By the time you get to, I need to understand cash flow for this business, get to the EBITDA less interest, tax, less your principal payments, get to that line on your income statement. And then you need to either learn how to do some modeling yourself, call me and we'll talk through it, go to an accountant to go through it, but you need to go through the formal process of calculating cash flow. I would say for most businesses, there's 6 or 7 different things you need to account for to go from what you see on the income statement to cash flow. Things like accounts receivable, inventory. Think about capital expenditures. So I had my $50,000 in Elliott's Amazing Widget Company, but I needed to go buy a new widget making machine. That would have been cash out the door. Cash in the door would be Elliott went and got a bank note or a revolving line of credit from the bank, and that would have been cash in. So just recognize that all these things we're doing is to make the analysis around deal making simpler. But when you really get down to the point where I'm going to go get $1 million loan from a bank with a personal guarantee, I'd encourage you to go through the full process of calculating cash flow. Did I completely lose anybody? It's okay. All right. Sure. Yep. So my process is always this. The first thing I determine is how big of an issue is it, right? Is this catastrophic, or is this mosquito in my ear, right? And you have to be careful here because you're paying a multiple of cash flow. Let's call it 3 to 4 times. So $100,000 issue can be $100,000 or $300,000 to $400,000, depending on whether it affects EBITDA or not, right? The first thing is you make an assumption, right? So it's it's a manufacturing company, Elliott's Amazing Widget Company. Manufacturing companies typically get paid in 45 to 90 days. I take an average of 60. That's probably their days sales outstanding. I run a model to see what that means for their AR. I'd use that as a basis for AR. And then during the diligence process, I would try to pull as many confirming data points as I could about that. So that's the first thing, is how big of a deal is it? Second thing is, can I get to some assumption that's close and then show it to the seller and broker? Oftentimes the data is there, Harrison. They just don't want to give it to you, don't want to dig for it, don't understand it, want to be tough. Life is life, right? The other thing, and this is where like diligence becomes so important, I can name you 2 to 4 documents that almost every business has that give you an indication of almost anything that's important in this deal process, such that it becomes almost laughable at times to not know, right? So like AR, I talked to Grant about it. Show me all the invoices. I promise you, somebody in that company has the invoices. I don't, payables don't have them. Well, you're paying your people, you have payroll, they're going to get paid. What's the check amount, right? You got contractors, how much do you own, right? Somebody's cutting those checks as well. What other, services and whatnot do you pay? Your credit cards are going to show that, your bank statements are going to show that. That stuff is going to be there. What's another one that I see a lot? Customer list. Everything's a round number. If you have QuickBooks, There's always a customer list in QuickBooks. If you have Peachtree software, there's always a customer list. If you don't have those things, the bank statement typically has Coca-Cola paid you, Pepsi paid you. It'll say it on the bank statement. So Harrison, we can talk more, but most of these things, the data is there. It's just not readily available. It's not part of their initial packet. Let me take a further step back because I think this will be relevant for a lot of you guys. Most of the issues I see in diligence have a huge ability to be improved if you think about who each person is in the process. And what that means is, how do they get paid? What do they actually know? What's hard for them? And like, what do they typically do? Now, typically do is going to take some muscle memory. But if you think about the seller is typically a high school graduate, maybe a couple years of college, that had the gumption to go start something. The stuff that he was doing worked, money started coming in, he hired people. He probably doesn't, or she probably doesn't like finance all that much, think it's a waste, thinks bankers are scoundrels, um, does the bare minimum to produce financials, and is also potentially the smartest person in most of the rooms, even though they might not have all the PowerPoint slides we like or the financial models we like. So you think about who that is. The broker has no agency or sort of no long-term skin in the game. He puts buyer with seller, gets paid when they consummate. He wants you to think the deal is great. He wants the bare minimum amount of data that you need to chew on to make a decision. Although he likes it if you spend a lot of time on the deal, in between just enough time and like medium a lot, he's going to get uncomfortable because the more data he has to present, the more work he has to do. It's a fixed percentage of the deal size. So you're doing $1 million deal, he's going to get 10% or so. So when a broker says they don't have it, you got to consider how much can you trust that. The other thing that happens is that the controller or the bookkeeper in these businesses and how the financials usually work. So we talked about the seller is typically a person that's not financial, that's an entrepreneur, doesn't even like finance typically. Their bookkeeper can go from wife, girlfriend, someone in that weird town that knows how to count well, no one at all, right? And so oftentimes the owner does the business, the bookkeeper puts stuff in something, and at the end of the year, they send all of that something to an accountant. And the accountant is supposed to be the checker of stuff. But when you pay an accountant $1,200 a year, I'll tell you right now, they don't check anything. So they take the garbage in, they put the garbage into forms. They say, hey, you owe $500 of taxes, and that's it. So now you come 20 years later and you're like, you know what? I'm going to talk to the CPA about this business because they know. You got to recognize they're never going to tell you I don't know. Like nobody's going to get you on the phone and say, hey, Harrison, like, man, they sent me a bunch of receipts January 15th. They don't really pay me a whole lot. I throw them into my system. I shoot it out. So when you're thinking about the questions you're asking as it pertains to data, think about who would actually know, because sometimes the question needs to go to the CPA because it's a technical question. Sometimes it needs to be the bookkeeper because they had to put it in the system. And sometimes even the bookkeeper might tell you the process they use to put something in. The owner is actually the one that knows. Hopefully that was somewhat helpful. – 80% of the time. And when I say price, I mean anything of substance within the deal. I mean, so when you see something in diligence, there's really three ways to handle it. You just purchase price, you just structure, which is when you pay, right? Um, well, four: purchase price, structure. You can protect yourself and make the seller bet on it in the purchase agreement, which is sort of like structure, but a bit different. Remember earlier, I was like, if you don't know if the customers are strong, make the seller bet with you. The seller knows way more than you. If he'll bet with you, that's confidence. If he won't, he can give you any story that you want. If he's not betting on it, you shouldn't. He's smarter than you in his business. The other way you handle it is you say, okay, like you need a better financial office in the business, and so you put that as part of your 100-day pan post close. But the size businesses you guys are looking at, the volatility. You see $1 million on the report from the broker, or you're going proprietary, right? And the guy says, "Oh, I did 5 million in revenue, 1 million in profit." Man, it's been clockwork for the past 5 years. You're probably somewhere between 500,000 and 1.5 million dollars of EBITDA. I mean, it's probably 50% swing. So almost all of these deals get renegotiated. Um, when I initially started this process of buying companies, I thought that I'm a man of my word. If I say I'm paying 3 million, I need to pay 3 million. If I start ratcheting it down, I'm a bad person. I'm not a person of my word. And I had a hesitancy around it. Now that I've been around it all this time, my disposition has changed. Now I tend to only deal with the truth, Noel. And so until I prove it, I don't believe it. And so the offer I gave, in its strictest terms, I bought with my letter and the time that I spend after the letter of intent, the diligence time, right? What I bought with that is a 90-day window to be the only one that can buy your company. That's the only trade we made at the LOI. I gave you some indication of my price. You gave me some indication of your financial. We both were off. Most of these deals get renegotiated in some way. We have about 15 minutes left. We have some more questions? Okay. No, excellent question. Um, I'm thinking of the most direct way to answer it. So, one of the podcasts I was on, I think it was Ryan Tansom. Podcast just dropped yesterday. We had a long conversation about this, and he represents sellers. I represent buyers. We're both pretty practical guys, but we know a lot of these tricks. I tell you, if you're not ready to kill the deal, you're not a deal person yet. I've seen quotes that I love that if you're not willing to walk away from a negotiation, you're not actually negotiating. You're actually determining the conditions of your situation. And so the calculus that I think is required is every renegotiation is going to cause some pain to someone. And that's why my first question typically is, how big is the pain? If it's $1 million deal and it's $1,000 worth of pain, I'm probably not going to break open the negotiation for that. It's a bad precedent, right? But I'm going to put it on my wall of things. Now, if we get to 20% of EBITDA, right? Now, for me not to renegotiate implies I'm willing to take a 20% overpayment because of my unwillingness to risk killing the deal. And I know it's tough because when I first started, I was the same way. But you kind of have to be willing to kill it. In fact, the best deal people I know up until the last moment of the transaction are looking for a reason to kill it. And it sounds Machiavellian, but it's just real. Um, if you ask anybody who's bought a lemon, they wish they would have spent those last 2 days looking at extra stuff. When you renegotiate with the seller, I think the posture towards it is important, Grant. As you can imagine, I'm very well organized. put together. I can bring my 25 list Word document and my 10 list on Excel. When you're dealing with a human, I think you got to sort of say, I don't know how to get here. Almost ask the seller to solve the problem for you. I thought your EBITDA was a million, and I'm looking high and low, and the most I see is 800,000. I mean, I talked to this CPA, I talked to this diligence dude, I talked to my friends on Search Funder, and at 800,000, I can't get to the purchase price. Um, I can't get financing. I don't think this dog hunts. Like I don't know. Can you help me find this 200,000? You said it was there. Where is it? And sometimes that becomes a better entry, I think, than um, entering with I need to reduce the purchase price 20% because EBITDA is 800,000. Um, and if you don't take my demands in a week, I'm cutting the deal. Hopefully that's helpful. Give them back their monkey. That's one of my favorite sayings. It's really their inability to present their financials accurately in their own business is their monkey. You actually have been duped. They gave you a false document and had you waste time. That's the other way to sort of get the gumption. You could have been looking at a better deal had they been honest. You wouldn't have looked at it at 800,000 bucks. You wouldn't have put the price of 4 million that they were willing to take had you known the EBITDA. That guy has wasted or that gal has wasted your time. So yeah, give them back their monkey. The other thing is, if it's a $10 million EBITDA business for sale, most of those businesses sell to somebody. There's enough cash in there to get somebody interested enough to buy. When you're talking about $400,000 SDE, $1 million in EBITDA, over half of those businesses never sell. So even though the broker told you there were six people behind you, there weren't six people behind you. This guy's got a live one with interest, with vigor in front of him. This process takes, 6 months to 3 years. If you feel a seller backing away, that's a diligent sign that won't show up on a spreadsheet, but you should be wary of. A reasonable seller will negotiate a reasonable deal, in my opinion. Yes, sure. It's hard. It's hard. It's hard. It's hard. My suggestions are this: most deal people, and I started the same way. You go to Biz Buy Sell, you look all up and down, you find three companies. Man, these are just the ones I want. I don't want to look at the rest. I'm going to go talk to these three. I'm going to buy one of these. And, two brokers don't hit you back. One guy takes 2 months. The reason I start there is because now the systems I use to generate online deal flow are like a labyrinth of connectivity points and assessments and filters that are organized, that are lined up. So I have a CRM that sits in Gmail, which is the email client I use. It's called Streak. Um, Streak is my task list. It's also my CRM. So the 1,800 brokers I know, the 2,200 bankers I know, all of the sites that I know that list deals, they're all in there. I know the last time I checked them. I know how many deals they had. The brokers, I know which ones send me decent deals, which ones send me terrible deals. I have all the deals they've sent me over the past 10 years. Um, I know where the guys' kids go to college and where he vacations. And it sounds like a lot, but deal flow is the oxygen, it's the water of your process. The likelihood of closing a good deal is directly related to how many deals you look at. And so, although I can't give away all of my database and all that kind of stuff, I do charge for it through my diligence as a service. And so if somebody's interested in getting a kickstart on deal flow, please let's talk, because I'm more than willing. I'm helping 2 or 3 people currently. But before you do that, organize it. Know what sites you're going to, know what brokers are there, Know when's the last time you spoke to them. Here's another thing that I think people get wrong, and this is kind of cool. I hope I'm not putting anybody to sleep, but like, I bet you there's probably a 15-year age difference of the people on this call, right? And on one end of that range, we like digital stuff. Don't call me. On the other end, it's like don't digital me, call me, right? Um, Brokers are more on one side of that range, and so you keep emailing these guys. Excuse my language. They don't give a fuck about your email. They're selling companies, man. The first dude that shows up with some money to buy this company, they're going to sell it to them and get their fee, and they're gone. However, when you treat people who have such a huge impact on your business like nothing, I don't have more than 30 seconds in a MailChimp email for Johnny Broker down the street. They're going to treat you like I have no more than 30 seconds for Grant, this amazing business buyer, but he's treating me like nothing, right? Um, One of the best ways to get deals, Harrison, is giving clear feedback on why you did not like the first one that you found. By far the best deals I've seen are the ones that are not listed anywhere, that, and this is not to show off, but if you and I called the same broker, right, he tell you he didn't have it, I'd probably talk him out of it. And not with credentials, just if you're willing to spend the time to get to know the person, to understand, ask questions like, hey, I'm sure you have hundreds of buyers calling you. What pisses you off about that? Or the last guy you gave a deal that he probably didn't deserve, how did he get it? What do you actually like about this business? What have you seen be indicative of the best buyers that you've encountered? How can I work most seamlessly with you to your benefit? If you're asking me how to get better deals, the best brokers I know, they don't send me the BS ones. When the ones have hair on them, they tell me where the hair is. Um, when I need a deal in the industry, they'll call their friends. We have relationships, and I think as you go from like broker 10 to broker 100, I encourage you to build a relationship. Now you're at an inverse of time, right? And I get it. Every quarter I evaluate, when I was on the buy side, every quarter I evaluated who were my 10 best brokers, and that's where I spent my time. And it was absolutely a function of how much love they showed me. Does that help? A couple of folks have been quiet. 210 number. I'm gonna murder this name, brother. Don't be mad. Adeware? Is that even close? Adeware. Okay. You have any questions, Adeware? That's how we all started, brother. Sure. I haven't come across it, but I'm assuming you found it somewhere. So that's the best diligence question for your lawyer. The lawyer you need on this deal is one who understands that. Email five and see what their answers are. The guy who has the most thorough answer, that's the one I would call first. I can admit that I don't know, and I don't want to BS you guys for anything. That's a great diligence question. And this is the same way I do it. Ask them the difference in between a 338G and a 338H. And then also ask them, one of my favorite questions is, walk me through the difference in between a stock sale and an asset sale. And it's a simple question, but you'll get to know a lot about a lawyer by how they answer that question. I can't tell you how many guys I asked with, Ivy League credentials that got that wrong. Sure. Yeah, no, great question. You need the scrappiest transaction attorney for deals your size you can find. Um, I've switched two or three times. My guys could chew through steel. They're just, and they're not jerks. They're just smart. They understand risk. They understand negotiations. We get on the call and we essentially yell at each other for a half hour, an hour. I mean, we're going hard. And I'm not a guy that likes confrontation, but I'm paying about an hour, right? So let's get to it. And then, all right, how'd that feel? Was that good? All right, cool. Much better document, right? And you're military, right, Raven? All right. So I mean, I think you got that. The same thing on the accounting side. So a lot of times people will use a service like mine, Diligence, as a diligence consultant, kind of in lieu of or in addition to a CPA. I'm biased here, and I need to admit it. I think a CPA is great at counting historical numbers. I don't think they're great at predicting future cash flow. Since you're not buying historical stuff, none of the historical dollars go to you. I think it's naive to deal with a financial and accounting diligence person that doesn't understand transactions well enough to be able to predict or at least project the next year's or the next couple of years cash flow. But regardless of who you choose, make sure that person is just a grinder, the scrappiest one. And the reason I use scrappy and not any of those nice Ivy League words is like this is a barbaric sport. Like this is it. This is big boy draws, big girl panties. Like there's no way to do this and be easily pushed around. And so you're going to find yourself in situations when who is Harrison, where the guy says he doesn't have data, right? Your accountant accepts that, you're going to have to accept it. That's a bad day for you. Um, Ahmed, I don't know if he's on or not, but he asked something about working capital this year versus last. If somebody doesn't understand the implication of that for the $1 million personal guarantee you're about to get yourself into, like you're stuck. The other thing about Scrappy is, and I'm okay to go over. I know if somebody needs to drop off, you can drop off. I'm enjoying this, so I'm gonna keep going a bit. Um, the good people in any industry know where they want to get to and can be patient enough to meander, discuss, negotiate their way to that outcome without having to be brash, even though they have the capacity to be brash when they need to. And so when you're assessing these providers, I'd encourage you to consider the best ones are like grizzly bears in teddy bear outfits. And so as you think about your providers, think about that. So the essential team, Raven, you need some a transaction lawyer, you need somebody to check accounting. Um, as you get more into it, mostly the searchers are checking the market stuff, right? So if you're buying something in oil and gas in North Dakota, you need somebody who understands oil and gas in North Dakota. That can be you with a lot of reading. It can be somebody who's been out there for 20 years. You got to understand that. Um, as you get further into the process, you're going to need insurance. If you're buying something that has potential environmental stuff, you're going to need an environmental team to go check. But if it was like I'm running through a desert and I can carry the fewest things with me, like get an amazing transaction attorney and someone who can really do diligence well. I also encourage you to check your people on earlier stuff. So these deals you guys are looking at that aren't fully baked, If you have an accountant or a lawyer or you have me signed up, ask me some tough questions on the stuff that's not going to go to fruition, right? That's a live bullet. These pontifications about how great I am, like you'll know when I'm looking at your deal and I pick up stuff you miss, you know? Yep. The best way, in my opinion, is LinkedIn. I made two best friends last year on LinkedIn. Never met them in person. We talk all the time. I've shared business with them. I've shared personal stories. I went to go visit a guy I met on LinkedIn like a month later, and I'm not a weirdo. It was just we were both in diligence. We both were entrepreneurial, and we talked on the phone for like 2 hours in the first one, and I kind of knew. To me, smart people want to have conversations about stuff they know well. Like, it's 2:02. I might be here another 10 minutes, 20 minutes. I don't know. I'm enjoying this, right? If you hit me on LinkedIn and say, hey, Elliott, I'm looking at buying a company 10 minutes outside of Atlanta, and I know they're telling me a story about working capital, and you seem like you are the working capital expert off of your LinkedIn profile. Could you give me 5 minutes on this working capital problem? I'm going to call you. And I think a lot of people are that way. That would be the easiest. You can always go find service providers that do it. But I think if you're bold enough in this world to ask smart people for help, a lot of times you can get it if you're them centric. Don't ask for a half hour. Don't ask convoluted, indirect questions. Specific, direct, boom. Other than that, dude, there's services like GLG and others that can hire a gun, find you an expert. But I actually think that in this process, you're going to have to get really good at getting comfortable with people you just met online, like these brokers and these sellers. You might as well start practicing. Yep. Hmm. Yeah, it's interesting. So my thought on this has evolved over my 10 years in this. So I'll tell you a couple of businesses that look like this to give you a sense. So like oil and gas companies, especially the service ones, had like a million in revenue, a million in revenue. 2014, 15 million in revenue. They wanted to sell inside that year, right? Or between that year and the next year. I don't know if you guys are familiar with specialty pharmacy companies. They are ones compounding pharmacies. So your regular pharmacy, you get your regular stuff. If I have a collagen restriction on my diet, and so the pill has collagen in it, a compounding pharmacy would produce that. They went gangbusters like 2015. Those things had super high revenues. The thing about super high revenues is they don't sustain most times. So um, what you do with it is you try to pay as little as possible at close, but generally I'm cautious of deals that explode. Do you mind sharing the industry? Yeah. I like that business, by the way. I don't know if I told you that already, but yeah. Yeah, exactly. And that's why I like it. It also typically doesn't attract a whole lot of people, so the multiples don't get pushed up too bad. Um, the way I think about so I would bet a lot of money that there was some big contract or some big project that happened. Have you gotten to that level? Yeah. So me personally, I treat those almost like so there's the steady business to me, and then there's any blip that happens, and they're different. So I'll pay a multiple that's reasonable on the steady business stuff they've done for the past 3 to 5 years, right? If you have a big bubble, I'm treating the bubble differently because I don't get any of the historical bubble. Anything over your standard, right? If you started and finished it, I said, hey, I got $1 million of work for you this year, but I only have it for you this year. You're going to take it. You're going to tell the buyer that it goes on forever. You and I know it doesn't. So I would try to treat the overage as much as an earn out as I could. Um, or some other way bet with the seller on the overage. So, SBA loans don't allow for this. Not everybody does SBA loans, but you might say, hey, look, I'll buy 70% of this. You keep 30. I think the value of this overage is about 30% of the business. And if it lasts for 3 years, I'll pay you for it. If it doesn't, I'll just buy your remaining 30% at the same multiple that I paid today. There's plenty of ways to structure it, and we can probably talk about that offline. But here's the thing. I've known people that have bought businesses on an upward trajectory like that did well, right? But I've heard way more people that caught the crash. The other thing, if the guy thought a huge increase was going to last, the question sort of becomes, why is he selling? You know? So I'm not saying that it's impossible, it's improbable. And if you want to talk more about that specifically, let's catch up some time and we can dig into it. Don't say it. So the reason why SBA is such a popular solution is because it's really the only solution for a lot of deals. Um, I'm in business school and I'm thinking, oh, banks lend on future cash flow. That's what they tell me, and that's what they do. I'm going to go in the bank, future cash flow. Banks lend on collateral. And so, unless you have $1 million building that you're looking for $800,000 of loan on, the likelihood that you get a loan for a business with 1 million to even $3 or $4 million in EBITDA, the likelihood that you get any cash flow lending on that deal is so low. That's why most people have to go SBA. Um, and I'll be honest about the non-SBA folks. The non-SBA folks are typically well capitalized. A lot of people in this game, have wealthy parents, wealthy families, and this is an alternative to a job. Um, and so they don't do SBA because they can put 50% equity in a deal and go get lending based on their parents' relationships. Most people are going to have to do SBA. Now, you said about I don't even like telling brokers that I'm only looking at SBA loans. Earlier in the conversation, I said you got to think about who these people are in the transaction and what messages you're giving to them. There's one school of thought to always be transparent. I'm not that guy. Um, I am like a school of thought of like how to win friends and influence people, and I always talk in somebody else's interest if I can. It's not sleight of tongue most of the time, but it is. I'm going to get you to do what I want you to do by talking in your language to your benefit. You don't really care about my benefit most times. When you talk to a business owner, an entrepreneur to put his wife, his kids, his mortgage, his future, his ability to function on the line for a business, right? And his broker is representing him, and you tell the broker, hey, this dude wants to go put 10% down and buy your stuff with 90% bank debt. If I'm the owner, I want to talk to the bank. I don't want to talk to you. The bank's actually buying the business, right? The other thing about SBA is it takes a long time, which is a bit of a pain in the butt, but it's not the thing to say on like the first date, right? Um, I think as you get to know people in the process better, you can mention that SBA financing is a piece that you're considering and kind of see what the reaction is. Saying that you're only considering SBA loans to a broker just increases your risk profile in their mind, which makes them want to give the deal to a person that looks just like you. He's actually not as smart as you, but he just didn't say it. in that capacity, you know, like not talk less. You know what I'm saying? Like you talk more, but don't say only SBA. Don't say I've only got 1 year to do this. I'm looking to close in 6 months. Don't say, you know, I've had 5 LOIs that I had that fell apart. Don't say, you know, I'm lamenting on whether I keep going on this search or not. Don't say, I don't know how I can come up with the 10% down. Don't say the 10% down is going to be 100% of my net worth. Like, don't, it's a negotiation from the jump. And I brought some friends into a deal in 2016, and one of my engineering buddies, and he just hadn't dealt with risk a whole lot in his professional career. And it's Ellie, why can't we be transparent? We could just be, let's be transparent. He doesn't say that anymore. It's a poker game. Ahmed, you asked a question about working capital. Sorry to take so long to get back to you. Working capital 2020 is lower than 2019 because of COVID. How do you deal with that? Average negotiation to have average or great question. The whole business is smaller, right? Wait, I'm not able to hear you. Yes. So there's like the academic piece of this and the practical piece. The academic piece is, you know, in accounting they have this concept of matching. You try to match costs, revenues, and costs in the same period, and so it shows an accurate piece of the business. So if I'm negotiating from a like academic perspective, I say just in general we should be speaking about 2020 because the business is not 2019. It's 2020, right? Now that's a little bit to your detriment in terms of working capital, but you get a way bigger benefit on purchase price. In terms of working capital, what I would say is that yes, not only is the working capital lower, but it's more volatile, right? Your business is lower, but the change in business size creates a bigger risk for me to take it over at this point, as opposed to waiting another year to see how things pan out. So I need a boost of X to get comfortable with that. And I can pay you X back in 6 months or 9 months, but I need a boost. And that might do two things. First, I think it creates a new negotiating stance of I need more from you, not less. And even if you lose the negotiation, you'll probably still get a decent working capital. But I wouldn't be paying 2020, I wouldn't be paying 2019 multiples and then taking 2019 working capital. And also in general, the seller's always going to want more. But if he's talking to you, I think you have a chance. The other thing, I use laughter a lot in my negotiation. So when I hear things that are just crazy, I just start laughing uncontrollably. It's more effective than you think because it says something you don't want to tell a guy or a gal to their face, but it's a polite bullshit. Profit, profit. Uh, Profits first, revenue consistency second. Um, I look to the balance sheet pretty quickly most times because people hide stuff on it. Um, Oh no, I told a fib. Okay. Uh, the first thing I look for is it actually from QuickBooks, like direct export, or did somebody play around with it in Excel? I can tell you some amazing stories I made about anything that I want to in Excel. You give me Excel in an hour, I can probably paint a giraffe. Okay. If I have my business and I export from Stripe how much revenue I got this year, or I go to my QuickBooks and export it, it's going to look like QuickBooks at the top. It's way more likely that's an accurate document than some either spreadsheet that somebody sent or that cute thing the broker did that he wants to explain to you. So the first thing I look at to see is it a direct export from a financial system or a tax sheet that's signed or a bank statement. And then I look at profit and then revenue consistency. And then also don't believe much of what you get before the letter of intent is all that accurate, to be fair. You typically get annual numbers and anecdotal stuff. So you need to have a healthy respect for you're getting a directional piece of data, not complete accuracy. Randy sent me a note. I think I'm close to a signed LOI. Curious to know more about the services you. Okay, and if you have time on here or offline, um, I'll give a quick piece here since we're out here. So I offer complete buy side services from the beginning of your process, deal sourcing, to the end, closing deals and growing businesses after you buy them. I mean, that's how you get the return. So the services, the way I have them split up, I have a quality of earnings, which is the typical analysis on a deal. So it's a look at the income statement, balance sheet, cash flow statement, working capital, customer concentration, any sort of trends that are important, understanding the consistency of different metrics in the business, and giving you a view on what the trailing 12-month EBITDA and seller's discretionary earnings are. This is what most people look for. This is what the bank looks for. So we provide those on a fixed fee basis. Why do you do a fixed fee? When I was in your shoes for 6 years as an independent sponsor, I don't even have long hair, but I'd pull it out and I'd ask people, hey, how much does the quality of earnings cost? And they started giving me, well, I charge 400 an hour. My lieutenant charges 300. My analyst charge 125. We do a blended rate. It'll be 18 to 40K. What? Fixed fee, which also aligns incentives in terms of I am incented to give you a efficient report that answers the question, is this business worth what you're paying for it? One of the big things with CPAs, as you get to know them better, they will make a mountain out of a molehill to increase the fees. So we've been through that. Don't want to go there again. That's us. We have a product that's a bit better than that called a quality of deal, where we both go into um, not just the quality of earnings, but now a 3-year cash flow projection, a debt paydown schedule, and a set of assumptions of what will change at the time of deal. So people look so much at trailing 12-month EBITDA, they forget that you're going to do several material things. The seller's gone. You didn't close any of the sales relationships. The head of sales has a lot of leverage on you. You're not as smart as the sellers. Things are going to get screwed up. You need to account for those things so you can start projecting next year's cash flow. So we provide a report that has the quality of earnings plus this projection. Noel, what you were building yourself is sort of part of what we do. I told you that there's other things that are important when analyzing cash flow that aren't on the income statement or necessarily considered in the debt covenants. We can help you build a full monthly cash flow statement so you'll actually know month to month not only how much cash you have, but how much cash extra you have, how much of a drop in revenue could you sustain and still pay your debt, and then how seasonal it is based on historical stuff. So that's our quality of earnings, quality of deal. Then we have diligence as a service, which is essentially where we have our deal sourcing, our deal negotiation support, our capital raising, our, hey, I need help managing the broker, the seller, and the process. All of those things are housed in diligence as a service. So we start that as $1,000 a month. It's a monthly model. and it just helps you with any and everything you need during your process. So it makes people more efficient. The big thing is when you start anything, like if I did whatever you guys do now tomorrow for the first day, I'd stink. You can sort of get up to speed way quicker, leveraging our diligence as a service model. And then let's say you have somebody else do diligence or you do a lot of it yourself. We have a sort of red zone review, which is you're 2 weeks from closing. I've done this work. I think it's directionally right. I'm not sure. I spent some money and it might hurt to spend a bit more, but I'm putting $1 million personal guarantee and probably 10 years of my life on the line for this. I want a second look. So we do the red zone review or a second look, and we start those packages at $2,000. Those are our main services, but we get asked all the time to do different things, and um, we're meant to be flexible for your needs. So we rarely say no. We try to figure out some way to make it work. Cool. Um, Email me. Say it again. Oh, hey, hey, how you doing? Yeah, I'm putting my email. I know you have it. Um, yeah. Mm-hmm. Yeah. That's exactly why we set up diligence as a service. Um, if I take a step back, part of what I do is run a business. We all understand that. Part of what I do is helping people who should be free, open, able to buy companies to do it with a service offering that's not readily available in the market. So, more than happy to help you think through your process, more than happy to help you set up a process that works for you, more than happy to help you get up to speed quicker, which means quicker execution, but also, as you know, I mean, you're an entrepreneur. It's not just did I make the decision left or right, but how comfortable was I making it? How well did I sleep? How well did I know the conditions around making it? Should I have made it? Should I have made it differently? We can help with all of that. And we try to very quickly demonstrate value so you sort of get what you're paying for quickly. So let's set up some time and let's talk. I'll send you a note. Yeah. Um, so when I was an owner, I always said I wasn't in a rush to sell, but if somebody wanted to overpay me, I would consider all offers. So I get it. Well, let's get set up. I'll send you a note to try to schedule time early next week. I know I can help you, and I think we'll have some fun doing it. So let's get set up. Excellent. Well, guys, I have time for one more question in this forum. I'm doing it again next week. I think I'm going to move it to noon to see if some people who couldn't make it at 1 can make it at noon. My email's still open, but does anybody have a question they want to toss out for the final one? Cool. Great question. Um, Raven, you have boundless energy. You could do as many things in this world as you want to. Whatever you put your mind to, you can do. And I'm not saying that just Mr. Optimistic. You know, I've lived this. Um, if I was willing to work with certain people who aren't as fun to work with as you guys, I could probably have 3 times the business. So most of the constraints are in your head and your willingness to work. Um, on one side, I think it takes 3 to 4 years to get good at any industry. On the other side of that, I think some deals at 3 times cash flow are a no brainer. Like, don't overthink it. Um, Not every business you buy do you have to run. So the search fund model is buy and run. The model that I was using was buy and have somebody else run. In that case, you create a holding company and you can do as many of those deals as you want. You don't have to do them sequentially. Um, in fact, there's way more historical examples of people buying 10, 20, and 30 businesses in a lifetime than one, particularly of this size. So does it benefit yourself to have 10 years experience in something? Sure. Do you need it to get something done? No. Will you learn more on your first one than trying to learn how to do your first one? Yes. And at this point in my life, the constraints are more physical and Elliott centric than capital centric. Dude, like if you're good at doing deals, people will throw money at you. If you're fun to work with, they'll find Raven Harris. Um, and if you want to talk more about people who have started where you are and gotten good at doing way more than 3 deals in a lifetime, way before they had gray hair, send me a note and I'll send you some folks on LinkedIn, and you can start that process. Cool. Well, guys, I'm gonna hop off. It's happy hour time. 2:30 on a Friday. I work for myself. I was up since 4. I'm going to the bar, but thank you for coming. I really appreciate you guys both coming and sort of contribution. I would hope that if you have other friends that are in the market for buying a business, that you let them know about office hours and let them know about our services. And then we'll be signing in again in a week, minus 2 hours. Absolutely. You guys take care. Bye bye. I know you like hearing that. Hold on, what'd you say? That's right. That's right. Y'all gonna pay me soon enough. I just got it was just a peep. It was just a peep show, baby. Just a peep show.